Hello and welcome to Gold and Silver Assets. I'm Diora and it's Sunday the 27th of June 2021. There are multiple factors that do impact the price of gold, and one such factor is interest rates. It's commonly thought that hikes in interest rates are bearish for gold. This is because gold is considered a non-yielding asset, and so holding it represents an opportunity cost when interest rates are high. But is there any evidence for this? How is gold affected by interest rates? Here we have a very, very long-term chart of global nominal interest rates from 1273 to 2017. From this, we can estimate a medium level of around 5% historically. Right now, the nominal interest rate remains historically low. What's the relationship between the nominal interest rate and the price of gold? Well, this chart shows that in red, the correlation between the two has varied over time, so it flips up and down between positive and negative. From the mid-80s to around 2000, you can see that they've mostly been positively correlated. So basically, when the 10-year yield shown in black dropped, so did the gold price. That relationship actually seemed to change in the early 2000s when the two have since been mostly negatively correlated. On the big time scales, that would mean that as the 10-year yield dropped, then the gold price rose. And that still seems to be the case right now. Interest rates are defined over a variety of different time scales, and so that gives us what's called the yield curve. And that curve can be flat, steep, or inverted. How does the yield curve relate to the gold price? So shown here in orange is the price of gold, and in blue is the difference between the 10-year yield and the 2-year yield. So a drop below zero indicates yield curve inversion, and I've marked those out with the black vertical lines there. So if these blue lines here, that's the difference between the 10 and 2, if that moves up, that means that the yield curve has steepened, and a drop below here means that the yield curve has inverted. So let's look at each inversion that's occurred. So if we go back here in the 1970s, the curve first inverted over here and the gold price rose after that. Now, of course, here there was a lot of up and down here, quite volatile. So I haven't really kind of marked any of those out there. But if we move on into the late 1980s, we had another yield curve inversion here. After that, the yield curve steepened a lot, but actually not very much happened with gold there. It was just kind of flatlined. So that didn't really indicate anything there. What about in the year 2000? We had an inversion just over here, and gold price initially kind of was flat to decreasing. But then as the yield curve steepened up here, so did the gold price rise. We had another inversion, only just around 2006 or 7, I think that was. And again, the gold price rose after that, and the curve steepened after that as well. And then finally, we have the most recent one, which occurred in 2019. It only just barely inverted there, and actually just reversed very, very sharply, as you can see here. And interestingly, the gold price rose after that as well. So not all the time, but most of the times that the yield curve has inverted, the gold price has risen after that, as has the steepness of the yield curve. It doesn't like being inverted. It's actually the real interest rate that investors are really interested in. That is the nominal interest rate minus the inflation rate. And this is usually calculated by subtracting the CPI from the 10-year yield. Here's a chart showing global real interest rates from 1320 to 2019. The green areas here represent times of monetary easing, and the pink areas are when tightening regimes were in place. Now, the first thing we can conclude by looking at this chart is that real interest rates have been in a downtrend like this for centuries. We can also see that big declines in real interest rates tended to occur during times of easing. So you can see these big drops here were during a time when this was shaded green here, and again here the same, and again here. And even more recently, since kind of 1990 really, you can see that this has been declining as well. Reversals to the upside in terms of real interest rates tended to begin when tightening occurred. So here you can see that once you transition here from the green to the pink, real interest rates actually move upwards. The same over here and over here. So the other thing that we can see from this chart is that negative real interest rates first occurred over here in 1800. And the most negative real interest rate occurred in the mid-1940s, actually. That's over here. And that was around minus 10%. But is there a limit to how negative real interest rates can go? Now, I'm not aware of a theoretical limit, but in Venezuela in 2017 here, you can see that the real interest rate was minus 80. So what's the relationship between real interest rates and gold? Again, this actually does tend to be quite variable, but in general, it's been noted that negative real interest rates tend to be associated with higher gold prices. Now, note that this isn't a hard and fast rule. It's not always the case. And it's not just that interest rates are negative. Sometimes the direction of the move is also just as important here. So we can see examples of exceptions here where the real interest rate was positive and yet the gold price was increasing in the mid-2000s here. And so yes, there are exceptions to that rule, but generally real interest rates are thought to be a strong driver of the gold price. So what conditions are needed for real interest rates to be negative? In a deflationary environment, the nominal interest rate should be greater than the level of deflation. That would be a situation where the Fed isn't cutting rates enough. Is there a limit to how much they can cut? Well, that's unknown, but we know that negative nominal rates are possible, as we've seen in Europe. In an inflationary environment, the nominal interest rate would be lower than the rate of inflation. In that situation, the Fed would not be raising rates enough to surpass the inflation rate. Here's a chart to demonstrate what that looks like. So the red line shows the CPI, the green line is the 10-year yield, and the blue line is the real interest rate. In the 1970s here, you can see that the rate of inflation here surpassed the 10-year yield, and over here in green, and so that resulted in a negative rate as shown here. Since 1980, over here, when the nominal rate was raised aggressively by the Federal Reserve, inflation has generally stayed below the rate of the 10-year yield. Of course, these days times are different compared to what they were in 1980. Back then, it was actually possible to raise nominal rates substantially, and part of that is due to the low levels of debt at the time. This chart shows that the US federal debt had, as a percentage of GDP, in 1980, it was only about 30%, but now it's over 130%. If interest rates were to rise, then that would cause major problems with even just making the interest payments. And that would risk widespread debt defaults. So keeping interest rates low is therefore of great importance. What mechanisms are being used to keep interest rates low, I hear you ask? What can they do? What tools do they have? Well, there are three main tools. One is forward guidance, and so that's when the central bank tells everyone where they expect rates to go in the future in an attempt to influence people's financial decisions and prevent surprises. The Fed started doing this in the early 2000s. The second tool is quantitative easing. And so this is where the central bank prints reserves out of thin air onto its balance sheet and then uses those reserves to buy bonds. And as a result, that causes the price of bonds to be bid up and therefore lowers interest rates. With quantitative easing, the central bank spends a fixed amount on bonds, but there's no stated targeted interest rate there. The third tool is yield curve control, and this also involves central banks buying bonds, but it does differ from quantitative easing in that the aim is to cap interest rate at a specific level. And so they'll buy however many bonds that are required to maintain that level. Basically, it's a blank check to keep a lid on interest rates. The Bank of Japan started using yield curve control in 2016, and it has been effective at keeping the Japanese government bonds close to zero. Last year, Australia implemented a limited form of yield curve control by targeting an interest rate of 0.25% on 3-year bonds. This hasn't been implemented in USA recently. However, USA has implemented yield curve control in the past. From 1942 to 1947, the Federal Reserve set interest rates for the entire yield curve. And for example, the 10-year yield was set at 2.5%. As you can see on this chart, this was actually very effective at maintaining that target there. Now we're going to take a look next at what other effects that yield curve control had. But do note that the economic and financial conditions were very different back then. And so I'm not saying that the same effects would necessarily occur today if yield curve control were to be introduced. But it's always useful to look back at history because you can still learn things. In order to perform yield curve control, the money supply must be increased. So from 1940, the monetary base was doubled. The US debt to GDP ratio also increased substantially over that time, from 40% at the start to 120%. Right now, this ratio is 130%. So if yield curve control were to be introduced, we'd be starting at a much higher debt level than they did back in 1942. Now you'd think all of this would stoke inflation, but what actually happened was quite interesting. As you can see on this chart with the grey line, inflation was already rising before 1942. And inflation actually subsequently dropped here and stayed low for most of the time that yield curve control was in place. It then spiked near the end here, and all of that just seems quite counterintuitive, isn't it? Also see that the interest rates were negative during this time, but then became less negative and then sharply negative. Okay, so this is all rather strange here, this action. So what is actually going on here? The answer is wage and price controls were introduced. And the aim of this was to control inflation. Extensive price controls were introduced in 1941 over here, but that didn't seem to be that effective. And so tighter controls were introduced, causing a steep drop in inflation over here like this. Interestingly, when the price control was stopped over here, but yield curve control was still in place at that time in 1946, you can see that inflation rose very steeply, very fast, up to 20% here. Okay, so how did various assets react to all of this? Well, on this chart is shown the S&P 500 from 1942 to 1947. You could see that stocks did very well actually, and they more than doubled over that time. Real estate also did well, even in inflation adjusted terms. So this is the inflation adjusted Case-Shiller home price index. And you can see this rise here from around 70 up to 110. What about commodities? Well, actually commodities stayed flat. So here you can see they were flat for most of that time during yield curve control. But then you can see this big spike up, and I think that's when the price controls were lifted then. If we break it down into individual commodities, as shown here, well, of course, the gold price was fixed at that time, so we can't really learn anything from that. According to this, it looks like here price controls were lifted around here, and copper, wheat and oil seem to have performed the best once those price controls were lifted. In conclusion, it looks like negative real interest rates are on the cards in the coming years. That's usually good for gold. I think yield curve control is likely to stoke inflation. Now you might say, well, that didn't occur in Japan in the last 5 years and it worked quite well. But look, I think the situation's different in many ways, particularly in the fact that we're talking about the world's reserve currency. Having said that, measures are bound to be introduced to try and keep a lid on inflation. And one such measure is the introduction of price controls. But I mean, can you think of any other measures that they could introduce to try and distort things? Overall, I think the result of any intervention is likely to be volatility in both inflation and the price of gold. So to me, that suggests it's not going to be an easy ride. Next up, the market update. Let's start with gold priced in US dollars on the daily scale. And I kind of think of this a bit like a boxer. So he's all chirpy here, jumping around, dodging things and so on. And then here, whack, he got punched. And so here, he's a bit dazed, stumbling around, not sure what he's going to do next. Is he going to get another hit? Is he going to be able to defend it and making the hit less powerful? Or is he just going to get up and have a second wind and cream his opponent? So look, not much happened last week. We've got this kind of area here which looks a bit like a consolidation. And so that makes me suspect we still have that little move down that I spoke to you about last week. The target would be the height of this triangle, which would bring us down to actually just below this line. It doesn't always reach the target necessarily. The other risk, though, we've got to think about is if this is the flagpole, upside down, of course, and this is the flag, then that's the other possibility, is that you get a drop similar to this drop here. So, yeah, we need to, this kind of 1740 something area over here is going to be important to see if we do get a breakdown out of this triangle. Now, of course, it could break up as well, in which case that's good news. The other thing to note is that the RSI is pretty low as well, though. And so that makes me think another big drop like this look, it's possible it could go very deeply negative down here, but I don't know. I'm still bullish on this, and the bullish thesis still hasn't broken. So I'm still positive about this. But those are the kinds of things to watch out for in the coming week. Now, a lot of people, as you know, for next week, there's a lot of hype about the Basel III coming in. So I think it's the 28th, that's Monday in Europe, and it's July the 1st in USA. That's my understanding anyway. Now, a lot of people are assuming that on Monday everything's just going to go sky high and rocket upwards. I'm a little bit skeptical of that. There's just a little bit too much hype about that, and I think there's a lot we don't know. You know, I don't think these things are as transparent, particularly when I was reading the original documents. It's not as clear cut, but you know, I don't have a deep understanding of that. Maybe others do. But the thing is, on Monday, you see, it could still drop because, of course, those regulations still won't be in play in London, which I think that comes in next year, doesn't it? And also in USA. So I don't think we can assume that that's going to be the thing that turns things around. It may do, which will be great. But yeah, don't assume things based on hype alone. Okay, and this is silver in US dollars on the 4-hourly scale, and we have a similar kind of triangle forming. And you can see that price has travelled quite a way along it. It's struggling to get above that $26 area. And as the further we get, of course, this is going to have to break out, and we're getting pretty close to the area where it will have to break out. And the question is which direction. So these lines are the lines to look for. If it goes up, great. But yeah, if it goes down, then we've got this line here. We'll take a look at that on the daily scale. So this is what it's looking like. So that was the big punch it got. This is staggering around. And so there is a potential drop down to this line here, which is about $25.30. Could it go lower? Well, yeah, there's two reasons. One is the height of this triangle is larger than that drop. But look, it doesn't have to meet that target. And the worst case scenario, of course, is this is an upside down flag on a pole. But again, you know, the RSI is pretty low for silver as well. Next, we'll look at the gold miners. So this is the GDX, and we're getting a similar story for all of these things. And note that we had a massive gap over here on its way down. So and up here as well, actually. So we've got a couple of big gaps above, as well as one massive gap up here, and maybe another one there. That's pretty small though. So we've got lots of gaps above. There's no immediately obvious other gaps below. And again, we've got this area of consolidation, and we're looking to see where it breaks out. I'm still thinking a small drop down before the turnaround. Now, in terms of Elliott wave theory, which I didn't mention for gold as well, this drop is, from my understanding, is thought to be a second wave potentially, in which case, if we just do get one small drop down and it turns around, that wave is a wave 3, which is usually a pretty strong wave, and we should get an impulsive move upwards if that is the case. But let's see. I think a further drop will frighten a lot of people. I know a lot of people are worn out. This has been going on for way, way longer than I think most of us expected. I certainly didn't expect it to go on this long. And sentiment is very, very low as well, though. And that's actually a positive thing, though, a quite bullish signal there. Let's move on to the silver miners. And this has been very wearing for a lot of people as well. I was surprised that it actually dropped as low as this. I thought we'd get support a little bit higher up before the turnaround. But look, silver and the silver miners aren't there to be your friend. You've got to you've got to wear through some of this kind of up and down movement. Really, it's not easy at all. Another reason why this might have another little dip lower is that we've got this gap over here, and will that fill? I'm not sure. It tried to fill it here and it didn't like it at all. Price just bounced right up. So yeah, there is potential to go down to 1450. Whether it will or not, I don't know. It depends on what silver does as well. But the big line down here is the one that we don't want it to break. What we want is a turnaround to occur here. And this time we really do want it to break above that kind of 1770 level. So yeah, this isn't easy, but I'm still positive, I'm still bullish. Now, some of you will have heard the news last week about this episode here with Coca-Cola. So Ronaldo apparently stated that, well, he basically told everyone to drink water. And he basically chucked the Coca-Cola out of the way at a press conference. And when that happened, the price of the Coca-Cola stock plummeted. But actually it did recover as well. But people have attributed this sudden drop to Ronaldo's statement. And I think it meant Coca-Cola lost $4 billion in its market cap. So, of course, then that got me thinking, I made those comments last week about Lindt and, how I'm thinking about maybe reducing or stopping my consumption of those gooey caramel squares in 2023. So what did that actually do to the stock price? Well, I actually pulled up the chart of that, and here it is. And as you can see, the stock price wasn't even interested. These investors know. And actually, the stock price has done really well. I didn't realize it'd done so well. So since about 2009, it's been up 680%. And it just seems to be kind of on a very, very nice bullish uptrend here. So, my comments didn't affect that. But look, I haven't got the millions of followers that Ronaldo has, I admit that. Apparently, one of our viewers actually said that stockholders, if they are able to attend the annual meeting of shareholders in Switzerland, then you actually get a bag of chocolates as well. But look, it's a bit far for me to go there for such things. Anyway, that's it from me for this week. If you liked it, then hit the like button. And if you'd like to hear more, don't forget to subscribe. And we shall see you next week. Bye.